everyone. Welcome. I'm going to give everyone just a second or two to kind of find their metaphorical virtual seat. Um, Thank you so much for taking time out of your day to be here with us. My name is Alana O'Connell. I'm part of the marketing team here at Holistoplan, and we are really glad that you're here. Before we dive in, I do have just a few quick housekeeping notes. This is the number one most common question we get asked here at Holistoplan, which is this webinar being recorded? And that the answer to that question is yes. We will email that recording to you after the session today. I want to walk you through a few of those tabs you see at the bottom of your screen. You'll see that the chat feature is turned off. That is on purpose. We just don't want to miss any of your questions. So if you have a question, Q&A tab. We will get to as many as we can live. There are quite a few of you registered for this session today, so I can't promise we'll get to everything, but we will do our best. You will also find the resources tab, which is where you can download the slides from today's session. There's also a link more about Holistoplan if you're interested in that. So today's conversation is all about tax planning, specifically how advisors can approach tax planning more intentionally and with a clear understanding of where tax planning ends and tax advice begins. After the question about webinars being recorded, I would say that's the second most common question we get asked here, which is how can I provide tax planning to my clients while remaining in compliance? So with that, I'm super excited to introduce our speaker. Stephen Jarvis is a CPA and the founder and CEO of Retirement Tax Services. Stephen partners with hundreds of financial advisors across the country to help them, as he puts it, stop tipping the IRS and start delivering measurable value through proactive tax planning. With nearly 15 years of experience as a CPA, he is one of the most recognized voices helping advisors bridge the gap between tax and financial planning. Stephen, thank you so much for being here with us today.
Alana, thank you so much. I am very excited to get to talk about taxes today. And I can genuinely say that I've been a CPA for a long time. I like taxes. One of the reasons I like being able to talk about this so much is that we all pay taxes and none of us really want to pay more. People might have differences of opinions on how much someone else should pay in taxes, but when I work with clients, they always tell me they'd like to pay only what they owe and not leave the IRS that tip that you mentioned. So we're going to get into this today and get really specific on what counts as tax advice and what you should avoid as a financial advisor and what counts as tax planning. And my goal is to help show you that there's actually way more that counts as tax planning that you can do compliantly than you might have previously thought. So Alana, so excited to have the opportunity to do this. There's already hundreds of people on the webinar with us. I always love seeing how excited advisors are to learn more about this. So let's get into it. I do want to give the quick disclaimer because my legal team asked me to of what we're talking about today is meant as tax education and not tax advice. And that might sound a little weird that I start a session about the distinction between tax planning and tax advice by saying, hey, I'm not giving you tax advice even though I'm a CPA. But the reason I give you that disclaimer, and I give that disclaimer to any large group I talk to, is that tax planning only counts when it's really specific. I'm not saying this is education, not advice, because I'm not confident in what I'm telling you. It's because for this to really matter, for it to deliver value to your clients, you need to apply it to their specific situation. So what I'm sharing today is based on real world experience. I prepare tax returns. I meet with clients. I work with hundreds, if not thousands of advisors a year. So I know what works in the real world, but you've got to apply it to those specific client situations. Alana told you a little bit about me, but again, just to reinforce that this isn't coming from a place of theory, it's coming from a place of reality. I have personally filed thousands of tax returns. I teach financial advisors all over the country, and I have for years. I've been asked to consult on all sorts of projects and have been published on a variety of platforms, including kitsis.com, which we'll talk about in just a second. But I do this all the time is the point. I've seen the objections. I've worked with a lot of compliance departments. And so as we go through this, as I talk about things and you think, yeah, but that won't work for me because, great, drop that in the Q&A. And I can almost guarantee that I'll have an answer for you because that's been my experience as I've worked with advisors at firms of all shapes and sizes. If you're willing to do the hard work, you can get this done. So mention that Kitsis article. It is a great deep dive. It was a couple years ago that I wrote it. It's all still very relevant. I wrote it in conjunction with the Kitsis team. And so there's a lot of great visuals in there and a lot of great references. So if you go to kitsis.com, or you can actually, my kids love this, you can go to Google and Google Stephen Jarvis CPA, and it's actually one of the first results. If you Google Stephen Jarvis, Kitsis, tax advice, that article will come right up. So there's one great resource for you that you can make sure that you take away from the webinar as well. So why taxes matter, why we spend time talking about this. This is probably why all of you are here. Every client pays taxes. Taxes come up every single year. Everybody wishes they paid less in taxes personally. And for the vast majority of taxpayers, no one is helping them pay less in taxes. By default, tax preparers are focused on last year. We're at the point where more and more advisors are talking to their clients about taxes, but it's still the rare exception. When you see industry reports on how many advisors think they're doing tax planning, the number keeps going way up. But when they survey consumers, the clients, to say how many of you are receiving tax planning, that number is still very, very small. And so there's still this huge opportunity for people who are willing to lean in and be that person who's helping their clients with tax planning. We just need to know what we can do compliantly and where we can deliver the most value. So the objections I most often get from advisors when I bring this up is one, as far as delivering value on tax planning, so I can't provide tax advice. They're saying, hey, compliance is in my way. I can't do this. I'm not allowed to talk about taxes, whatever that looks like. And it's always this really vague idea of, well, I'm just not allowed. Because I'll actually 100% agree. For probably 99% of you on this call, there might be a couple of CPAs or attorneys in the audience, but for 99% of you, you 100% should not give tax advice. What we're going to talk about today is what actually counts as tax advice and the things you should definitely avoid. And then kind of this big, beautiful blue ocean of things that you can do compliantly. The other objection I'll hear is, well, hey, that's the CPA's job. That they're licensed to talk about taxes. Leave it up to them. Leave it up to the enrolled agents, the tax people out there. And personally, I would love for tax professionals to do more around tax planning, but I can't control them any more than I can control you. And as a general rule in life, I like to focus on the things that I can be personally responsible for. So as an advisor who's clearly interested in taxes, that's why you're here. Don't abdicate your responsibility to your client by saying, hey, I hope somebody else is doing this. Because again, chances are their tax professional is not. If they're lucky, they have a tax professional who answers some of their phone calls during the year. Most clients I talk to before they come work with us, and definitely the general experience I hear from advisors, is that the tax prep experience is maybe a couple of emails exchanged during tax time. It's not even, hey, help me adjust my withholdings. It's just, hey, yep, we filed your tax return. Let's move on. So while you're welcome to use these as excuses, that's what they are. They're excuses. They're not valid reasons to not do more for your clients. Because CPA, certified public accountant, I have a whole list of things that could stand for. Otherwise, copy, paste, assemble, pain, and you get it. But CPAs really, their job, what they're asked to do, is to make sure the numbers get reported to the IRS correctly. They're not tasked with doing tax planning, and so they don't. They're also not typically taught how to do tax planning. On the other side, whether it's CFP or whatever other designation you do or don't have, we're just thinking about this as financial advisors. Depending on the designation that you have or the education that you've gotten to get to this point, maybe you've had a little bit on taxes, but in my experience, it's not extensive, it's not in detail, it's not enough on its own to get you to a point where you're delivering massive value to clients on taxes. So we're left in this situation where, again, nobody is really by default helping clients with taxes. And so it creates an opportunity for people who are willing to lean into it. This is how I like to kind of visualize how this opportunity works. We have tax value that we can deliver to clients, and we have the investment it takes to deliver that tax value. And that investment can be your time, it can be resources, it can be coaching, it can be software, it can be all sorts of ththings that we can invest in that help us move to delivering more tax value. And I meet a lot of advisors who either just kind of write it off and say, hey, I can't do tax planning because if I'm not a CPA / CFP / attorney / I was a valedictorian and could deliver a baby, what's the point? They have this delusion or this illusion that like there's this unicorn situation that until I get there, I can't do anything else. But the reality is that is the rare exception that exists. And that we're at the point where every financial advisor is having an impact on taxes. It's just that some of you are doing it on purpose and some of you are just letting it happen. And even the biggest name providers out there, the ones that I'm sure most of you have at some point have scoffed at to say, oh, well, they don't really provide value to clients. They are starting to wade into these waters. Now, it's very low on the value scale as far as what they're delivering, but that means the rest of us are somewhere in between. And if we're letting this happen by default, we're way closer to the bottom left of this graph than we are to the top right. We have to intentionally take steps to move ourselves up and to the right if we want to deliver more value to our clients. And the great news is the tax code is publicly available. There's so much information out there. You absolutely could DIY all of this. You could only invest your time and move up the tax value scale. The point here, though, is that you have to do this in a way that's meaningful to your clients, and you have to do it intentionally. This won't happen by accident. So let's define tax advice versus tax planning, and then we'll get into some of the things that you can do to move up. So tax advice, the way the IRS defines tax advice, and they tend to be the authority on this kind of a thing, they give two examples of what is tax advice and what everybody on this call absolutely should avoid unless you are, in fact, a CPA or an attorney or an enrolled agent that you're licensed to represent clients before the IRS. And the first one is, in fact, like literally representing taxpayers before the IRS, which you cannot do on accident. You are at zero risk of accidentally giving tax advice by representing the client before the IRS. Like how could that even happen that you accidentally represent a client before the IRS? So that's one of the definitions the IRS has for tax advice. The other one is interpreting new and unclear guidance, which this one can get a little bit trickier when tax laws are changing all the time. We had new tax laws this last year. There are things that can take the IRS years to clearly define how they're interpreted. And so it's absolutely something we want to be aware of. But again, not really something you're at risk of accidentally doing, especially if you take the time to understand the tax principles, the tax strategies that are most relevant to your clients. If we narrow in on just the portion of the tax code that comes up the most often, then we can be a lot more confident of, okay, what have I seen in the past? What precedence is there? What do I feel confident is very clearly set guidance? And that's it. Those are the only two areas that the IRS has defined as tax advice. Now, in practice, I get that tax advice gets used more broadly. Often advisors can fall into this area where even if they're not giving tax advice as defined by the IRS, they're hesitant because of what compliance has told them tax advice includes. And so there are definitely things that are important to be aware of and things to try to avoid where we can. So flying solo, especially if you are newer to tax planning, we want to involve other professionals. We want to collaborate. This isn't go ask your CPA as a cop-out. When we talk about leveraging other professionals, if you want to deliver value to your clients, you need to help facilitate that conversation. Because the reality is, if you say, oh, yeah, there'll be a tax impact, go ask your CPA, most clients aren't ever doing that. And I know that because I talk to clients, I talk to other CPAs, I talk to advisors. And if you as the advisor who the client came to as an expert, they said, hey, I want to pay you so that you can be the expert in my life. If you then give them homework on a topic they're not comfortable with to go ask another professional that they've always been intimidated by, they're just not going to do it. So while we want to collaborate, that has to be proactive and intentional. It can't just be, hey, go ask somebody else. I would absolutely encourage you to avoid signing tax returns. That doesn't really fall into tax advice, but there are a whole list of compliance things you need to go through if you're going to sign tax returns. Really, just a different discussion if that's something that you're looking to do. And then making really definitive statements, and we'll talk about language to use instead, but these are areas that are more likely to get you in trouble with compliance. If you say, hey, this Roth conversion as an example, you doing this Roth conversion will cost you exactly $13,682 in taxes, and it's going to save you $606,000 over your lifetime. When we make definitive statements, that's more likely that a client's going to come back and anchor against that and say, wait a second, this isn't exactly how this turned out. So again, we'll get into the language that makes more sense and creates more value for clients and make sure that we stay in line with compliance. But it shouldn't stop us from doing these things. We just have to be aware of them. The last thing that I know most advisors would consider to be tax advice is, well, whatever else your compliance department says is tax advice. And every compliance situation is going to be a little bit different depending on the environment that you're in. But I've worked with advisors all the way from solo RIAs all the way up to advisors who are with the biggest BDs in the country. And all of them, especially over the last few years, are more and more able to do at least something on tax planning if they're proactively working with their compliance department and treating them as a team and not an enemy. So even things like getting tax returns and reviewing tax returns. Again, I've got examples of advisors at every shape and size of firm you could think of that are doing that with compliance's blessing. Because as we talk through this, none of this is meant to be, hey, and hope nobody notices. Whether we're talking about tax planning and hoping the IRS doesn't notice, terrible idea, or we're talking about compliance department and say, well, I'm going to do this anyways. I'm going to go rogue and we'll just hope they don't notice. That's not my intent at all. You can do this compliantly, but one of the relationships you need to build, especially if you're in a larger firm environment, is proactively reaching out to your compliance department and understanding where their concerns are and how you can navigate that. Because at the end of the day, compliance serves a very important role and can add a lot of value to you and your clients if you proactively work with them. Yes, it gets boiled down to, and some of you may have had experiences where it just feels like, hey, we're just trying to not get sued. But it turns out if you're constantly getting sued, you're probably not delivering value to clients and you're probably not going to stay in business. So I'm actually okay with not getting sued. But when we can treat them as a team, instead of saying, hey, I know you're not going to let me do this anyways, but I really want to, it's okay. What would I need to do different to be able to send out a year-end tax letter? What would I need to do different to be able to get tax returns and review them for clients? And the better we can illustrate to leadership, to compliance, hey, here's where there's value in this. If you're keeping track of how often prospects ask about taxes, how often clients ask about taxes, how often you're having an impact on the tax return already. Because I mentioned at the beginning, every advisor is doing tax planning. It's just that most of them aren't doing it on purpose. And what I mean by that is every financial decision, recommendation, event, everything that has to do with money has a tax impact. It's going to show up on the tax return at some point, whether it's this year or in the future. Even something that seems simple like funding a 401k. That's inherently a tax planning decision. So great news, you're all already somewhere on that scale. You're doing some kind of tax planning. We just want to be more intentional about it. So then as I outline this framework, which I do dozens of times a year with advisors, then we always have to come back and make it a little bit more specific. So this is where you can jump into the Q&A. And I'll give a couple of examples here of, okay, what is it that we're worried still might be tax advice? And I'm not looking for the esoteric things of, hey, if I help a client try to move to Puerto Rico so they only pay 4% in income tax, is that tax advice? That applies to so few people. Let's just skip over that. And let's talk about things that come up on a regular basis. So what is it that you're worried that comes up that you say, hey, I see value in talking to clients about this, but I'm not sure if I'm allowed to talk about this. So like I said, I'll give a couple examples while you guys think of ones that are relevant or recent for you. I had an advisor come to me recently with a very large BD who had gone to their advanced planning team to say, hey, I think I have a client who would be a good candidate for an NUA. And they went to the advanced planning team. The advanced planning team gave them some literature around NUAs, but then basically told them like, hey, that's a CPA's job. You shouldn't talk to a client about this NUA because that's tax advice. And so as I'm talking to this advisor, I said, well, personally, I completely disagree, and here's why. Now, the delivery matters. If you go to a client and say, hey, you absolutely have to do this NUA or whatever the tax rate is, you have to do this NUA, you have to, and here's when you have to do it, and here's how you have to do it, and here's what it's going to mean. If we're definitive and we're prescriptive with it, we're at much more risk of this being tax advice and getting ourselves in trouble with compliance. If instead we can approach this client and leverage other experience we have and say, hey, Mr. and Mrs. Client, for clients in a similar situation to you, here's what we've seen work in the past. And here's what we've seen be the tax impacts in the past. And here's how we think this will work in your situation. And we would love to facilitate the conversation with your CPA to make sure this is how this is all going to apply. Now, we'd have to do an entire separate session on how NUAs work and really get into the nuance of when that's applicable. But that general framework is what the advisor went back and used with this client because he's not committing to this is definitely the outcome, and he's making sure instead of just copying out and saying, "Hey, go ask your CPA," he's facilitating that conversation. But it's not tax advice to share what you've learned from other CPAs. Hey, I was on a webinar the other day, this came up. It's not tax advice to share what's happened to other clients, but we do want to include that caveat of, hey, let's work with your tax professional to make sure that's the same way it would work in your situation. Okay, so there are a couple of questions jumping in here. Feel free to keep adding more. So making a calculation on how much they can fill a tax bracket for a Roth conversion. Yeah, Roth conversions are a great example of where totally get why questions come up around this related to tax advice. And I think the approach matters. And so when I work with advisors on how they approach Roth conversions, a couple of things we want to focus on. We want to make sure we're starting with a framework of why are we doing this? And I want to focus on the potential of tax savings and creating tax flexibility. I'm going to reinforce to a client over and over again, we don't know what tax rates are going to do in the future. And so I'm not a huge fan of trying to illustrate, hey, over your lifetime, this is going to save you $2.5 million of taxes, because we don't know that. And when we throw out these huge numbers over their lifetime, it's an anchor point that they're going to come back to. But if we start with the foundation of here's the philosophy behind why we're going to do this, and in your situation, we think it makes sense to convert in this bracket, which will create the potential for taxes of between X and X, or X and Y, because two different numbers. I talk in ranges, and part of the reason I do that, one, I'm not making definitive statements, and that is important from a compliance standpoint. But two, it also allows me some flexibility, and I just share this with the client, of based on what we know now, here's what this would look like. But taxes are so interwoven. There's so many things that can impact this. I'm going to give you a range so that if something else comes up we're not aware of, we have some flexibility there. We're not going to be surprised. And so anytime I'm working on Roth conversions, whether we're looking at a tax bracket or an IRMA bracket, I'm always going to give myself a range, and I'm going to leave myself a buffer because what we don't want to do is we don't want to let trying to optimize for math get in the way of getting things done. Because if we try to beat the numbers until they're perfect, we're probably not actually going to execute on it. So those are ways that again, as I talk to compliance departments, large and small, those are ways that we shift ourselves away from that line of we feel like we're getting tax advice to, hey, we're having meaningful tax planning discussions, and then we're going to work with their tax professional to make sure it gets handled correctly. All right, Jason says, when using financial planning tools like Right Capital or Income Lab, they give estimates of lifetime tax savings and recommended Roth conversion brackets. How would you specifically explain these to a client compliantly and implement the advice? Oh, okay, so clearly I didn't read the question ahead before I made my last comment. So I'm a big fan of software tools to help advisors understand what the implications are. There's so many different pieces to this, especially when you have situations where the premium tax credits get involved for people who are getting insurance through the marketplace, or we're up against IRMA thresholds, or we're looking at different tax brackets. I love using software to help with the math. I personally am not a fan of then turning around and giving those reports to clients, because now you've just given the client a report that they can take and hold on to and come back to that says, oh, your lifetime tax savings is $2.5 million. And that's what they're locked in on. Now, for me, and I would imagine for many of you, I'm not recommending Roth conversions because I'm convinced that it's absolutely going to be $2.5 million. I'm doing it because I've evaluated a client situation where they have a disproportionately small amount of tax-free dollars, and that from my work with other clients, I know that they are going to be better off having the flexibility of having tax-free dollars at some point in their future. We can also look at their future income and when different income sources are going to turn on and reasonably expect, okay, you're going to be in a higher tax bracket in the future. But so I'm a big fan of those being used internally. I'm not personally a big fan of giving clients these big, huge reports that to the client are going to feel like they're being promised future savings. And I know there's asterisks and caveats there, but if you show a client, I mean, think about it from the client experience. If you show a client, hey, 2.5 million of lifetime savings, they're not thinking, oh, asterisk. They're thinking, man, that's $2.5 million. All right, Emmy says, evaluating doing pre-tax versus Roth contributions in a retirement plan and projecting lifetime tax savings over choosing one or the other. Okay, I mean, similar idea. And there's lots of tools out there for this. Personally, I'm going to come back to it's not what does the software tell me is going to be the lifetime tax savings. I'm looking at what bracket are we in now and what do we expect for income in the future. And I'm going to reinforce to clients all along the way. Anytime we make a plan for the future, it's subject to change. We don't know what's going to happen. My crystal ball is broken. I don't know if Congress is going to change the rules or your life's going to change in a way you weren't expecting. But I'm going to focus on where are we now and where do we expect you to be in the future, whether it's based on your income or what Congress might do. And I'm also going to, I think the other thing that helps us from a tax planning versus tax advice standpoint or staying compliant is that we're not going to make a plan and then set it for the next 30 years and hope it all pans out. We're coming back to this. And I'm going to reinforce to my clients that, hey, based on the laws we have today and the information we have right now, here is what makes the most sense. Here's why we're making this recommendation. And then we're going to come back and revisit this each year together because I am a big advocate for Roth, but it's not the magic answer in every situation. There are plenty of times I tell a client not to do Roth, but it's something I'm going to at least look at for clients each year. Oh, we've got a big Roth conversion fans in the crowd. Roth conversions, when modeled in e-money, show the lifetime tax savings or lifetime net worth impact. You said something earlier like advice is telling clients how much they will save in taxes. Is this advice or planning? Okay, Paul, great question. So let's kind of remind ourselves the way the IRS defines it, whether we tell them tax savings or not, like that's not in the technical definition of advice. From a let's stay compliant with what we're expected to do to make sure that we're not getting in trouble with this broader definition that's kind of applied to advisors more often. In general, I don't, whether it's taxes or not, I don't want to promise outcomes. I want to explain the rationale behind what we're doing and help the client understand when we're going to revisit this and how we're going to adjust for it in the future. And so again, it's part of the reason I don't love the like, hey, we're doing this because we're going to save $2.5 million. The way I explain it to clients is we're looking at their whole situation, and here's one of my favorite explanations to use with clients. Most people at some point are going to need a large sum of money. Hopefully that's for something fun, like a trip around the world or an RV. It could be for something not fun, like medical expenses or a new roof. When we need a large sum of money, if all of our savings is in pre-tax accounts, we're going to get killed on taxes. If we have a balance between pre-tax and tax-free money, we at least have the choice of where that money is going to come from, and we have more options to not get killed in taxes when that comes up. And so that's just one of the examples I give to clients of why this makes sense without tying it to, hey, you have to do this because it's $2.5 million of savings. Now, some of that is preference, but that's an approach I've seen that compliance is happier with, and then also just sets a more realistic expectation for the client of, hey, we're building a foundation for what's going to set us up for success. We're not trying to guarantee a particular outcome. All right, we'll do a couple more of these, and then I'll save time at the end for Q&A as well. So if I don't get through them all right now, don't worry, we'll come back to it. And then Alana has promised that she'll send me all the questions after the webinar as well. And so I'll make sure everybody gets an answer whether it's live today or not. So I'll do a couple more here. Aaron says, asking a client to consider restructuring as an S Corp for more opportunities to create retirement account versus sole proprietorship or LLC. Will this be tax advice that crosses the line? So Aaron, it depends on when we involve that other professional. Because if you are not a CPA yourself, then at some point before this gets executed, I would absolutely involve someone else. But it's not my opinion, and what I've seen from other advisors and talking to compliance departments, it is not tax advice to bring up the idea. It's not tax advice to explain how it's been beneficial to other clients in similar situations. It's not tax advice to say to share with a client what options this might present. Now, especially if you're not a CPA, if you take that the next step and say, nope, in your situation, here is the only outcome that makes sense, let's go ahead and do it. Now we might be getting ourselves in trouble of, wait, why didn't you talk to someone who has more of an expertise in this area? But what I find too often is that advisors they basically stop at the start line when they say, well, I can't see it all the way through. I don't even want to bring it up. But there's so much of this that you can bring up before it ever becomes tax advice, as long as we're talking about it. As long as we're talking about it correctly. And so that's where I try to help advisors say, okay, here's how we can take this a lot further to the point where the client sees the value and wants to follow through on this. The other thing I'll say real quick on entity selection, and this wasn't really implied in your question, Aaron, so you might already be totally good on this. But I see a lot of people start the entity selection conversation around taxes, and entity selection is always a legal and business consideration first. We need to understand what it is we're trying to protect and how we want to operate our business before we ever get into the tax planning side of it. Life and or tax planning in general, we want to make good life decisions, good business decisions, then figure out the tax efficient way to go about them. So we always want to make sure that order of operations is correct. Okay, one more here, and then we'll save some time at the end for Q&A as well. Andrew says, so as far as use of Holisticplan in general goes, if we show a client a tax report which has specific numbers, should we just be adding the typical disclaimer that these numbers are estimates based on what their prior return says, or should we not even be showing them specific numbers? Great question, Andrew. I work with a lot of advisors who are extensive Holisticplan users. And so we want to bucket this into a couple of things. So the Holisticplan report that shows you the summary of prior year tax return, great, show clients that all day. That's data that's already been reported. That's you just summarizing their tax return in a different way. If we're using the scenario side of it to say, okay, let's model a $40,000 Roth conversion. Even in that situation, I like showing multiple scenarios. I was so excited. I think it's been years now that Holisticplan added multiple scenarios. I was so excited when that came into it because then we can show, okay, Mr. and Mrs. Client, we had talked about potentially this amount of a Roth conversion. Here's what that would potentially mean based on what you've told us so far. And here's what it would mean at a couple of other, and I'm going to do my best to pick relevant measures. I'm not just randomly picking other dollar amounts, but it's, okay, if we did the tax bracket before, the tax bracket after, did the next IRMA threshold. And then, yes, we of course are reinforcing, hey, this is estimate based on what you've given us. And not the goal of today's webinar, but I feel like I have to reinforce it anytime I can. When we're talking about Roth conversions, one place I see advisors get part of the execution wrong is not making it clear, crystal clear to clients how the taxes are going to get paid and when the taxes are going to get paid. Because you can take this valuable experience for the client of, hey, I'm going to convert to Roth and fill up this tax-free bucket, and then kind of sour the whole thing if it wasn't clear to them when and how the taxes are going to get paid, and then there's a tax bill due at tax time. Because if you aren't super clear on that, or if you haven't facilitated a great relationship with their tax preparer, if the client has a balance due at tax time, the tax preparer is going to look for anyone to blame but themselves for why there's a balance due. And that Roth conversion is going to be a prime candidate for getting blamed for why that balance is due. Great questions. I love it. I know there's several of others in there. We'll come back to some at the end. And like I said, if we don't get to them live, Alana's going to send them to me. I'll make sure you all get answers. So please keep dropping them in there. So in my experience, at the end of the day, this distinction between tax advice and tax planning isn't the problem. This might seem a little bit harsh, but this has been my experience working with advisors. The problem is, whether it's conscious or subconscious, it's avoiding the hard work it takes to get this done. Because my intention here is not to illustrate this as if there is an easy button that you just magically push and you're never going to do tax advice again. Or there's an easy button you magically push and great, now I'm an expert at all things tax planning. There is work that goes into this. Taxes are the single largest expense that most people have in their lifetime and certainly throughout retirement. And so it is complicated. It takes work. But it doesn't have to dominate. It doesn't have to dominate your life. Like as advisors, there are lots of other things you need to do as well. And so taxes don't need to take over your whole life, but there is hard work that goes into it. And so that's where we go back to that graph of, okay, where am I at now and how do I intentionally and effectively move this up? So if you're looking for the solution that says, I can do tax planning and put zero work in, I'm sorry, it doesn't exist yet. Another reason that I'm so passionate about this topic, mentioned it a couple of times, I just want to get a little bit more specific about it. Advisors are already having an impact on the tax return. I'm doing my best to advocate for let's do more about it. Because even if you aren't proactively doing what you consider tax planning, there are so many things that have that tax impact and can commonly create mistakes on the tax return if we're not paying attention. So we're shifting here. There's a lot of questions about Roth conversions. They're great. I love forward-looking planning. There's also this element of we need to be involved in making sure that the things that we do with clients, whether we consider them tax planning or not, are reported on the tax return correctly. Because if it doesn't get reported to the IRS correctly, it doesn't really count. So we're getting into another tax filing season, and so I'll update this again after this tax filing season. But this is just a quick list I put together from last year's tax filing season of things I saw mistakes happen, even if well intentioned. And some of these are clearly tax planning. Some of these are just things that naturally come up if you manage investments, if you work with somebody on a financial plan. These are things that by default the tax reporting isn't great. So let's take a couple on here. Equity comp. Now, you could have clients who receive equity compensation, RSUs, and you could be sitting there telling yourself, "Oh, well, I don't do any tax planning." But by default, the way a lot of RSUs are reported, we have a W-2 that reports the income when the RSU vests, and then we end up with a 1099 that reports the sale of the RSU with a zero basis. And some custodians are getting better at showing in a supplemental schedule, oh, hey, it wasn't really a zero basis. Here's what the adjusted basis is. But at least every year or so, when I bring on new clients, we're seeing situations where clients are paying income twice on the same, or paying taxes twice on the same income because they didn't understand how this was being reported. They didn't have someone in their life who was verifying, hey, did this get reported on the tax return correctly? And I mean, we can just we can keep building this list bigger and bigger, and I did. This isn't a short list of things that can potentially go wrong when it comes to taxes. Again, whether we think we're doing proactive tax planning or not. Again, even if all you're doing is managing investments, we see 1099s every year that have missing basis on stock sales. That maybe this was because someone changed custodians and didn't get reported over correctly. Maybe it was equity comp related. Maybe it's just a mistake. There are errors that happen on 1099s every single year. Sometimes 1099s are late. Sometimes they get amended or modified. If clients change tax preparers, there's a huge risk that carryover capital losses won't get carried into the new tax preparers tax system. And so there's all these different things that can come up that as you look at this isn't meant to be, wow, that's a lot, I better just stay away. For all of you watching, there are some of these that are going to be relevant whether you think you're already doing proactive tax planning or not. And so just like we can take the 80,000 page tax code and narrow it down to the tax planning strategies that are most relevant to our clients, we can do the same thing with common tax mistakes that might come up to say, okay, here are the ones that are most relevant to my clients. These are the ones I need to understand best. The other thing, as we look at tax advice versus tax planning, I always like to find, okay, where does the rubber hit the road on this? And please, if you have examples that I'm not considering, please reach out to me. But I have yet to meet personally the advisor who has been sued because of proactive tax planning they did that went wrong. I've heard of one or two situations where it's happened, but when I talk to E&O providers who have some really good data on who's getting in trouble for tax planning gone wrong, they're not giving me examples of people proactively doing tax planning and a client getting upset. They're constantly giving me examples of advisors who didn't think they were doing tax planning, but were having an impact on the tax return. They're constantly giving me examples of advisors who don't understand that these mistakes can happen, who don't understand that even if they say, hey, I'm not giving tax advice, every money movement has an impact on the tax return. And so there's kind of this dichotomy to it of there's really just this kind of responsibility that if you're going to be involved in money, you need to help clients understand the tax impact. And then there's the other side of it of, hey, I can be proactive and help clients save on taxes, help them have a long-term plan for how they're going to access pre-tax money without getting killed in taxes in a particular year. And so we can look at it from, really, ideally, we should be looking at it from both sides of what's my responsibility for the things I'm already doing, and then how can I keep expanding what I'm doing to deliver more value to clients. And Alana mentioned at the top, but these slides are all, you can download them. So screenshot it if you want, but you can come back to all of this. I've mentioned a couple of times, I want to give a couple of specific examples because at the end of the day, the way I measure the impact of what I'm doing with things like this is attendees' abilities to go and take action. So I want to make this as specific as possible. So we talked about it a couple of times. The way we talk about these things does matter. And so here's a couple of kind of just phrasing that I've seen that makes a difference both in the confidence for an advisor to go out and say, okay, I can do this without immediately being at risk of giving tax advice. And then I've always found scripts helpful. I've always found, okay, I want to find people who are doing the work I want to be doing. Say, okay, teach me how you're doing this and modify this so it resonates with how you talk. But here are some of the ways that I've found to help clients, for advisors to help clients do more on taxes without getting into tax advice. So I mentioned before, what has worked for other clients. So we just talk about Roth conversions, NUAs, QCDs, charitable giving of other kinds. Instead of saying, Mr. and Mrs. Client, this is what you have to do, say what has worked for other clients, because you're kind of giving yourself and the client too, this context of, hey, I don't know for sure this is going to work for you, but we've seen this be valuable before. Use real life examples. What has worked for other clients in this situation and spell it out for them. Have a call to authority. What I've heard from CPAs. I was attending a webinar the other day and learned from a CPA who does this all the time. So you're calling on other people's authority. Now, this needs to be accurate and real. Like, don't just vaguely invoke Stephen Jarvis in all of your conversations in the future, but especially when you talk to your compliance, if you're in an environment where taxes have been shunned in the past as something you can talk about, great. Leverage authority from other places to make sure that you can continue these conversations further. And then this piece I mentioned about, hey, it needs to be reported correctly for it to count. Make sure that ideally you're going to facilitate relationships with clients' tax preparers where you can have those conversations together. You're going to facilitate that conversation. If you don't have that relationship, then at a minimum, what you should be doing as you talk to your clients is, hey, what you should let your tax preparer know. And you're reinforcing to them, backdoor Roth contribution would be a great example of this is something that won't get reported correctly by default unless you're setting a client up for success. So what you should let your tax preparer know is here's how much we contributed, here's when we contributed it, here's when we converted it. And you're spelling out for them, here is the relevant data to make sure this gets reported correctly. The other great thing about this is you're reinforcing to your client throughout the year, hey, here's the value that we added. So it gives you an excuse to go back and say, hey, remember all that great stuff that we did earlier in the year? Let's make sure it gets reported on the tax return correctly. So we come back to this graph that I showed at the beginning, just because this is at this point, this is how I think about this quite often is how do I go from where I am, and you'll have to self-identify, okay, where am I at in this matrix currently? And if I want to move up in tax value, I'm going to invest more time, more resources, whatever that is. But there's a couple of common themes that I see from people who are consistently moving themselves up. So the first one is communicating complex topics simply. Now, there are absolutely resources that can help you do this, but you've got to know what those handful, maybe it's a half dozen, maybe it's a dozen tax strategies that apply most often to your clients. And you need to practice explaining these things. There are some great questions about Roth conversions, whatever that topic is. Practice on your own situation, practice with team members. You want to be confident and consistent with how you explain the value proposition. This is not how do I give a dissertation and explain the complex algorithms behind the perfect or the optimal Roth conversion. It's how do I clearly and succinctly explain to a client, here's the value proposition. So the advisors who are better at communicating these complex topics simply are the ones I see deliver more value on tax planning. Consistency of getting tax returns. One of the first times I met Roger Pine, one of the things we talked about was this idea of every client every year. And it's one of the things that him and I have consistently really kind of championed together of, if we could wave a magic wand, every advisor would get every client's tax return every single year and then do something with it. And what that do something with it can look a lot of different ways. That could be as simple as, Mr. and Mrs. Client, we got your tax return and made sure that the work we did together was reported there correctly. And if all you do is manage a taxable brokerage account, that can be 3 minutes of, yep, the interest and dividends got reported. Yep, the capital gains got reported. That's not tax advice. You're just verifying that the work you did ended up on the tax return. But no one else has probably done that for that client before. And if you explain to prospects that that's something you do, that's probably something that they've never heard of before either. So you absolutely, this is back to it takes hard work. You absolutely need a system for what you're going to do when you get those tax returns. But if I could wave a magic wand, every single one of you would get every single client's tax return every single year. One more point to highlight on getting tax returns. This applies in other areas as well. But if we don't set expectations, we won't like the expectations clients make up on their own. And so what you should not do is just mass email all of your clients and say, hey, send me your tax returns with no other context. Because if you just ask your client for their tax return and give them zero expectations yourself, they're going to assume that you're going to do a full audit, that you're going to make it so they never pay taxes again. Like they're going to have this whole laundry list of, oh, they asked for my tax return. They're going to do all these things. They're going to do it tomorrow. And so anytime we're doing these things, we want to set expectations for what we think the outcome is going to be. And so, especially if you've never asked for a tax return before, you really can start as simply as Mr. and Mrs. Client. We look for ways every year to level up what we're doing. And this year we've started asking all of our clients for tax returns. We're doing that so we can verify that the great work we did together showed up on your tax return. And so when you provide your tax return, we're going to check a couple of things. We're going to let you know it's all good. And that can be the starting point, and then you can build from there to identify other opportunities, to start bringing this up in client meetings. But we want to set the expectations of what we're going to do and what that timeline is going to be. It'll create a much better client experience. Year-end summaries, 1099 letters, whatever you want to call this. Holistic Plan has a great tool for this, but however you get it done, especially if you're doing, it's February right now, if you're doing tax planning for 2026, the client is not going to remember in February of 2027 what you talked about in February of 2026. And so you're helping make sure this gets communicated correctly, gets reported correctly, you're reinforcing the value you provide. You're just doing an incredible service for your clients, because tax documents that come from the custodians by default do not give all the information. Even this year, as the 1099-R has added a box for, or has added a code for qualified charitable distributions, QCDs, most of the custodians have said, yeah, we're not ready to actually start using that yet. So even that feels like a step in the right direction. There's always going to be a gap between what's on the tax documents and what the tax preparer needs to report these things correctly. So huge, tremendous value in providing some kind of year-end summary. And then the last thing, and this might feel a little bit broader, it probably is and applies to more than just taxes, but the people I see delivering the most value on tax planning are the advisors who focus on action, not attention. So, I mean, I have a podcast, I'm on LinkedIn, like I do all these things where, yes, I want people to watch what I'm doing. So I get the appeal of wanting to talk about the flashy things of, hey, the IRS isn't going to notice if you buy a Tesla and put your logo on the side. That's not how that works. You can't just deduct a Tesla because you put your logo on it. But rather than focus on what gets clicks, focus on what gets results. Focus on, even if it feels really simple. One of the things our clients absolutely love that we do, and we know this because they bring it up all the time. We went through, we went to the IRS website. Everybody on this call could do this themselves. We went to the IRS website, had somebody on our team make a $1 payment to the IRS. And the reason we had them do that is so they could go through every single screen of making a payment to the IRS and screenshot everything and provide instructions. And that may seem simple and obvious, but we were getting clients asking questions how to make that happen. So we made a step-by-step guide of how it happens. It doesn't have to be complicated. It has to be something the client can take action on and they can see the value in. So those are the most common areas where I see, okay, these are advisors who are consistently delivering value on taxes. So again, the way I measure the impact of what I'm doing is how people are taking action. And so I'll get back to Q&A in just a second. What I challenge you to do as you wrap up this webinar is say, okay, what am I going to do? Where am I at? And what's one action? What are two actions that I can do? I can put on my calendar, I can make real, that are going to help me move up and to the right. They're going to help me deliver more tax value, whether I'm investing more of my time, I'm investing in other resources, whatever that looks like. That might even just be learning from peers. Whatever that is, what are you going to do to take action to move the tax value up that you provide to clients? Because if you don't take specific actions, we're just gonna be in the same place next year. So really appreciate everyone attending. We've got 12 minutes here. I'm going to jump through more of these questions. So please keep dropping them in there. I'll just leave on the slide a couple of places you can find me if you'd like to learn more about what I do. And then we have a desktop tax guide that anybody can download for free that just has some of those key tax data points that you probably don't want to commit to memory. So let me make sure I'm in the right place here. Okay. Alana, are there any that you want me to start with, or should I just keep going down the list?
I was gonna say I can read some. There were some that I was really hoping that we would get a chance to answer, so I can read some of those to you right now.
Let's do it. Yeah.
Okay. Carly asked, I love this question. From your experience, what would the best steps be as someone new to the industry that sees the competitive advantage of providing tax planning and wants to include this in every client meeting?
Yeah, so Carly, some of it's going to depend on where you're at currently with your personal tax knowledge and experience. I think the best way to get better at anything is to get reps in. And so for people who are literally brand new to this, I would start with your own tax return and cover up your name, pretend it's not you. What could you learn from that tax return, or what would you talk to a client about on that tax return? Because you know everything about your situation. And then I would go from there to, okay, which clients do I already have tax returns for? There are lots of great resources. That's what I spend all my time doing, is providing resources to advisors. But I mean, you can do this on your own if you're willing to get the reps in. But starting with real tax returns for real clients is the best way to narrow down and know which topics you should focus on. Because if you're if you're not working with any equity compensated employees, great. Skip all of that equity comp stuff. Don't worry about RSUs or ISOs or anything else. If you exclusively work with business owners, great. That's where we're going to start. Or if you only work with retirees, great. I really want you to understand IRMA and QCDs and RMDs, and that's where you need to start. But I've converted from pictures or it didn't happen to tax returns or it didn't happen. If whatever resource you are leveraging doesn't at some point make it really clear that you need an actual tax return, you need to pick a new resource. Like we've got to get to the real data, and then just keep getting the reps in.
Yep, awesome. Okay, there's another great question, which the question itself is great, but I also think it speaks to kind of a larger question that we see a lot here at Holistiplan. Anonymous asked, what if you educate the client on a Roth conversion strategy, suggest the client review with her CPA, and the CPA is not knowledgeable and tells the client, don't do it because your taxes will increase this year versus lifetime taxes. So I think this is a great question, but I think this is also kind of a theme that we see in that advisors don't want to step on the CPA's toes.
Yeah.
There's questions about like, how do I communicate? How do I work collaboratively with my client's CPA without, insulting them?
Yeah, it's a great question. Thanks, Anonymous. So it definitely comes up a lot. Couple of things on this. One is timing. If you want to build good relationships with tax preparers, you need to be asking these questions outside of the filing season, if and before the end of the year. Because if in February you're asking or you're telling a CPA about something you did with a client last year, that CPA is going to say, "Oh, the advisor didn't care about my opinion. They went ahead and did it before I could give any input." Now, you might not actually care about their input, but I mean, if we want to build relationships, we need to treat people like peers and professionals. And so reaching out at a time where they still could give input if they wanted to. And then this is one where I would basically write the email for the client. Let's back up for a second. You should assume that anytime you send a client an email about another professional, there's a good chance they're just going to forward it to that professional. So just take this a step further and just write the email assuming that that's exactly what they're going to do. In fact, you might even encourage the client to just forward it to the CPA. And here's what I would include. I would include in there, hey, Mr. and Mrs. Client, like we discussed, we're considering helping you do a Roth conversion of between X and Y, which we know will create taxes this year of between X and Y. And just as a reminder, the reason we wanted to do this is even though it's going to create taxes in this year, it's going to fill this tax-free bucket and set you up for having this great foundation in the future. So I would reinforce all of that in the email so that when it inevitably gets forwarded to the CPA immediately sees, oh, the client's already been told this increases taxes this year. The advisor's taking responsibility for what the value proposition here is. And if you've already talked to the client about how those taxes are going to get paid, I'd include that in there as well. But we want to clearly include those things because most of the time, if you take that approach, the CPA is just going to keep moving on. Like, okay, great, let's move on. Because the CPA is trying to avoid getting in trouble at tax time when the client has a surprise bill due. Most of them are working with so many clients, they probably just don't care to get involved in the conversation. So you've got to make it easy and clear. And there could be exceptions where I've met CPAs who very much embrace the attitude of why would I ever pay taxes before I have to? Roth is dumb and will always be dumb. You could get to a point where if you think Roth conversions are a key part of this person's retirement plan, that you might have to have a tough conversation where you say, hey, when we work with clients in your situation, here's why we do this and here's the outcome we see. And if you're working with a CPA who is going to always stand in the way of that, it might be time to look for a new one. That's more the exception, but you've got to be prepared that that could be a difficult conversation you need to have.
All right, I saw a couple of questions about clients who self-prepare their taxes. I'm going to read this question
Please.
from Emmy. What advice do you have for a client who does their own taxes but would like to
Mm.
discuss a Roth conversion with me? I think that's a great question, but I also there are a couple of questions about like how do I navigate this with clients who self-prepare?
Yeah, so that there's for the most part, especially like in my slides, like it'll talk about tax preparer, like getting this to their tax preparer, because that includes if it's them, and maybe even especially if it's them. I'm not opposed to DIYing. I think in some cases it makes a lot of sense. Just like we might look for signs where it's time to look for a new CPA, we might also like kind of have our checklist of, hey, signs it's time for someone to stop DIY in their return. But even if you think that they're adamant about DIY in their return, they're going to do it forever. We're still wanting to communicate the same information of reinforcing here's what the conversion was, here's what the taxes are, here's how they were paid. If they're DIYing, I would really specifically reinforce to them which tax documents they need to be on the lookout for. Of okay, if we did a Roth conversion, you're going to get a 1099-R that shows the money coming out of the traditional IRA. And here's one that gets people all the time is they'll file their tax return and then in May or June they'll get a 5498 and they'll freak out and they'll say, "Oh no, I didn't have this tax return, this tax document. I need to go back and amend my taxes." And so letting them know, like, hey, you're going to get a 1099-R in time for the tax return and you need that. Later, you're going to get a 5498 that's really just going to confirm what we already knew. Don't worry. You can send that to us when you get it, but it most likely will not mean that you need to amend anything. So kind of helping set some of those expectations will help as well.
All right. I think we've got time for one or two more. Greg asked, tax advice or not, calculating withholding for IRA distributions. My is want us to do this.
Oh, great question. So Greg, okay, so again, not an attorney, but my opinion and what I've seen advisors do over and over again, and I've seen compliance departments get on board with, is that the messaging matters. But yes, absolutely, you should be helping your clients with understanding the tax impact of IRA distributions. But again, this is where the language matters. If we want to make sure that, well, so kind of depends on the context you have. Another reason that you should get tax returns for clients, because how much needs to get withheld, how much the taxes are going to be on the IRA distribution depends on the rest of their income situation. If you don't have their tax return or a good picture of their total income, you have no idea what's going to be withheld there. IRA distributions are also a great opportunity to help a client avoid underpayment penalties and not get killed in taxes at tax time for income sources that don't by default have withholdings. So I see it all the time. We'll have new clients that work with us who they've got Social Security that doesn't have withholdings against it. They've got taxable brokerage accounts kicking out a ton of income that can't have withholdings against it. And so they're constantly angry at tax time or getting hit with underpayment penalties because no one has helped them understand how they could pay those taxes otherwise. So again, we want to make sure that we're using language of, hey, clients in your situation or based on the information that we have, or here's what we're going to communicate to your tax preparer. But no, giving clients an estimate of what the tax impact is going to be and making it clear to them this is an estimate based on these assumptions, that's not tax advice.
All right, we've got time for one more, and then I'm going to close us out. Sarah said, "Great work. This was an awesome session. The presentation was comprehensive and meaningful. I will definitely be using this information. That's awesome to hear, Sarah. She wants to know what are all of those medals behind you."
Oh, that's very nice of you to ask, Sarah. I have a good friend who says that they're a desperate cry for attention. That may or may not be accurate. What they actually are, they're race medals that I do. A lot of them are Spartan races. It's basically my visual reminder of my commitment to be healthy, both physically and mentally. And so I do a bunch of races every year. In fact, I've got a stack of medals on the ground that didn't have room to hang up. So yeah, it's just I learned a long time ago that if I'm physically active, I'm just a more pleasant person to be around. So I constantly do races.
Love that. All right, thank you so much, everyone, for staying on with us. There are a ton of questions still in the chat that we didn't get to, but we will do our best to answer all of those in our follow-up email. I'm going to include a bunch of resources in this follow-up email. We will include the recording from today. We will include the slides. There were a ton of questions specifically about Roth conversions and modeling those out. Here at Holistiplan, we have a lot of resources. We have videos, we have articles, we have live webinar sessions. So I'm going to share a bunch of those Roth conversion related resources with you. If you want to learn more about Holistiplan, if you want to schedule a personalized demo or start a trial, there is a link in that resources tab at the bottom of your screen where you can click to learn more about us. I hope that we hear from you. We will get this follow-up email sent to you by the end of this week. And I think that's all we've got. Thank you so much, Stephen. This was incredible. I'm so glad that we did this. I'm so glad that there were so many people here um, live to watch this happen. Thank you, everyone, for setting aside an hour of your very busy day to hang out with us for a bit.
Thanks, Alana. Happy tax planning, everybody.
Happy tax planning, folks.